Hey there, everybody. Welcome to the Independent Women's Forum. We're very excited to have you here for our live broadcast. This is a policy chat hosted by our Center for Economic Opportunity. I'm Carrie Sheffield, the Senior Policy Analyst at the Center. I'm going to give a little background about our webinar today and then introduce our wonderful panelists. So as maybe you've seen on our title, we are looking at how to protect the lending services for unbanked low-income Americans. It's a very vulnerable population, and we want to make sure that they have the products that they need to flourish. And while the vast majority of Americans possess checking and savings accounts, they also use credit cards and finance major purchases with loans. A surprisingly large share of Americans struggle with financial barriers to opening and maintaining financial accounts. This makes daily life more difficult in an increasingly cashless society, particularly during rising inflation. Now, the lack of access to financial services doesn't mean they are not desired or needed, particularly by lower income households. A variety of lending services fill in these market gaps, including check protection services and installment loans. The public and policymakers should be aware of the vital role that these services play. And while it's tempting to criticize those specializing in serving this population and to view the fees charged and practices employed as exploitative, these services, they actually fill a critical need and must be taken into account. The short-term nature of the loans, plus the higher risks and the cost of providing these services. In fact, some of the most heavily criticized financial services practices, so-called installment loans or payday lending and check protection services, they actually enable vulnerable communities to participate more fully in today's tech-heavy economy. Without them, people are forced to turn to the black market and be even less likely to have access to banking and loan products. So we're going to delve into the policy behind it, but from our perspective at Independent Women's Forum, we believe that policymakers should be very careful when they're considering policy reforms and encouraged to continue innovation in the financial sector and recognize that consumers are best positioned to decide which services meet their needs at any given time. Because despite regulators' best intentions, interventions often restrict consumer choice, ultimately resulting in fewer options and higher costs. Now let's get into this discussion. First, I'll introduce Tirza Durant. She is Director of the Tech Policy at the American Consumer Institute, which is a nonprofit educational and research organization. As ACI's Director of Technology Policy, Tirza writes on a wide variety of technology and regulatory related issues. Prior to coming to ACI, she worked for a think tank in Pennsylvania where she focused on economic and fiscal policy. She's also has experience working with think tanks around the globe and has been fortunate to witness firsthand the positive impacts that policy can have in individuals' lives. Tirza, welcome.
Thank you.
Also, we've got Patrick Brenner. He's the founder and president of the Southwest Policy Institute, a research institute dedicated to improving the quality of life in the American Southwest by formulating, promoting, and defending sound public policy solutions. Prior to launching the SPPI, Patrick worked in public relations and marketing at an Albuquerque, New Mexico firm. Patrick's experience in public relations, advocacy for transparency, and a desperate longing for accountable government have primed him for leading the American Southwest state-of-the-art think tank, where he empowers liberty through a data and technology-fueled grassroots movement. Patrick, welcome.
Thank you so much for having me, Carrie. It's a pleasure to be here.
And last but certainly not least, Ann Petros was named Vice President of Regulatory Affairs at the National Association of Federally Insured Credit Unions in October 2021. In her role, Petros leads the advocacy to federal agencies, including the National Credit Union Administration, the Consumer Financial Protection Bureau, and the Federal Housing Finance Agency. Petros joined NAFCU in June 2016 as a regulatory affairs counsel. Prior to joining NAFCU, she worked at a law firm focusing on complex commercial litigation. She's a member of the Virginia State Bar and active in the Young Lawyers Division of the Virginia Bar Policy Association and the American Bar Association. Welcome, Ann.
Thank you, Carrie. I'm very happy to be here today.
So let's dive right into this. So Patrick, let's start with you. You recently led the release of two recent white paper investigative reports that the Southwest Public Policy Institute has conducted and completed in the last few months that are relevant to this topic. One is called No Loan for You and investigated how the war on specialized emergency loans has hurt New Mexicans. And my colleague, Patricia Muka, our director of the Center for Economic Policy here at IWF, she co-authored some reporting about this. Let our viewers know, if they're unfamiliar, what did your organization decide to research, or why did your organization decide to research this topic, and what were the biggest takeaways for the policymakers?
Sure. Well, I mean, those are great questions, Carrie. Thank you so much for asking them. One of the driving factors behind the Institute's decision to weigh in on the short-term lending front and using price controls and interest rate caps as measures to control access to consumer lending was one, New Mexico instituted a rate cap, and that law was passed last year and went into effect in January. Two was the Pew Charitable Trusts based out of Pennsylvania announced that 6 of the 8 largest banks in the United States were now offering consumers a new specialized emergency loan in the form of a quote unquote small dollar short-term loan that was available from these big banks. Now, of those 6 banks, there are 3 that have branches in New Mexico. One is US Bank, 2 is Bank of America, and 3 is Wells Fargo. What we had done was attempt to actually emulate the consumer process. We wanted to find out exactly what consumers were experiencing as they attempted to borrow money from these 3 big banks. So us being the scrappy upstart that we are, we wanted to emulate that experience. We actually applied for the loans directly from US Bank, Bank of America, and Wells Fargo, and we were denied by all 3 banks. The experience was less than desirable, and certainly not the experience that many consumers have when they're leveraging a non-traditional alternative lender in the form of a traditional installment lender for borrowing a sub $1,000 loan for anywhere between 4 and 8 months. So at those 3 banks, the lending criteria is a little different. They don't actually run credit checks. Now, in lieu of a credit check during the application process, this is just for a $1,000 loan, less than $1,000, several $100s. I couldn't even get a $200 loan. But the process for these 3 banks is you have to have an existing checking account that has recurring direct deposit history for at least 12 months. Now, we've coined the term specialized emergency loan because that's what these loans are. While some members of the industry in the short-term lending sector refer to them as traditional installment loans, we see these as specialized emergency loans. It's a special type of credit that can be accessed in an emergency. So many of the lenders that are working in the space offer these loans with as little as 24, 48, or 72-hour turnarounds for access to this money. And when you're experiencing a cash deficit and you need $500 to repair a vehicle or get new tires, that money could be needed tomorrow. Or even as early as today, so that you can make those repairs to your vehicle. So for these banks to come to the table suggesting that they have these specialized alternative loans available to consumers, but then change course and suggest that you have to wait a 12-month period and have established direct deposit history with that banking institution is it's not good. It's not good, and it decreases consumer access to this badly needed credit. Now, as soon as that interest rate cap went into effect in New Mexico, we saw double-digit decreases in the number of alternative lenders currently operating in the space in New Mexico. That, and when so many New Mexicans, especially in the Albuquerque metropolitan area, we're talking double-digit percentage points here, when so many New Mexicans are considered unbanked or underbanked, as a report several years ago, they need access to alternative lending solutions that are often not provided, and we've proven are not being provided by the major banks, as identified in the Pew Charitable Trust report. So we launched the investigation, we applied for the 3 loans, and we published the findings of our report under the title No Loan for You, and that was earlier this year.
No, I think it's very important that you point out the scenario, very real world scenario of, needing some money to pay for the car repairs in a very sudden circumstance. And of course, in a lot of these situations that you're talking about, you're also going to have to wait maybe 1 to 3 business days. And there's the turnaround, even if they were eligible for the loan. But as you said, they're requiring a lot of paperwork and a paper trail that it's a chicken or egg. If you don't have the paper trail, how are you going to get the loan? And quite often they're completely squeezed out. So we're really grateful that you kind of went under. You're like the MI6 of credit loans.
We're the secret shopper of the credit loan industry. Yes.
No, very helpful. Thank you. And we'll get more into your second report later. But Tirza, I want to talk about this because, we saw this, the unbanked population, that's who generally we're talking about, but it's generally, more broadly low-income Americans as well. So I just want to bring in, your work there at the American Consumer Institute, especially from the tech side of it. How do you all think about these policies? And just give us kind of a bird's eye view of how you all are thinking about it.
Yes, thank you. So technology has really impacted how businesses and consumers interact if not every segment of the economy. And that applies to the banking and lending as well. But unfortunately, what we see is some of the bad policies from traditional financial sectors are making the transition to digital as well. And we see a lot of proponents of certain policies, such as rate caps for short-term and long-term loans, really pushing to make sure that digital financial services are covered by these types of regulations. And I work in tech policy at the American Consumer Institute. So one of the things we really focus on is protecting consumer welfare. And part of that is protecting the wide array of consumer choices. And when we look at polling, I believe the Terrence Group came out with numbers, and about 96% of respondents said that they really value having access to short-term loans and that they see them as really useful. And what we see is that when you're protecting consumer welfare, you're not just protecting their choices, but you're also respecting the choice as well. And you touched on this a little bit, but there's definitely some narratives that short-term lending is predatory, and you have these kind of loan sharks that are preying on an unknowing consumer. And that's just not the case for a lot of individuals. There was additional polling that came out, and it stated that people really understood the terms of the agreements that they were signing. And I think they understood the length of time, they understood the fees, they understood how long it would take for them to pay it back, but it did serve a real market purpose. And so from the consumer perspective, we really want to protect all financial options. And yes, short-term loans may not be the most ideal solution in every single circumstance, but they definitely play a role. And protecting the consumer means protecting a lot of options for their financial services and respecting the choices for those who do choose to pursue that type of option.
Mm-hmm. No, thank you. That's and I think it was Thomas Sowell. I believe it's Thomas Sowell who gave just the analogy of, people say it's predatory. It's, the interest rate, if it was, annualized, it would be, 400%, but he gave the comparison of a hotel. If you stay in a hotel and you're there for a couple of nights, that's not the same thing as renting the room and being charged a 400% increase, but it's a short-term situation, and it's something, as you said, in terms of the consumer welfare standard is under assault more broadly too, not just in this area, but the consumer welfare standard overall. We've seen federal regulators and some policymakers want to completely remove decades of case law of the consumer welfare standard. We did a whole policy chat on that as well previously. I know Senator Mike Lee is interested in enshrining a protection for the consumer welfare standard. So thank you for highlighting that, Terza. And let's bring you in here. So the National Association of Federally Insured Credit Unions, your employer, you represent credit unions around the country. What is your perspective on these lending policies there at NAFCU as it relates to products that many low-income Americans rely on, but that are currently under fire right now by regulators and lawmakers?
Yes, thank you for the question. So NAFCU does represent credit unions across the country, big and small, federally chartered or state chartered, and there are nearly 137 million members. So all kinds of consumers across all 50 states and US territories. And credit unions really are more diverse than any other financial institution out there. There are 3 times as many credit unions designated as minority depository institutions, for example, than banks, and 10 times as many female CEOs at credit unions than banks. Credit unions are also more likely to lend to minority and low-income individuals, and often they're the only financial institutions in underserved areas, especially rural areas where banks have, have closed branches at really alarming rates. For example, since March of 2020, banks have closed more than 4,000 branches across the country, and that's about like 200 closures per month. During that same time, credit unions have actually increased their presence in these communities by about 2.5%. And so that, I think, just highlights the focus that credit unions have on these low income and disadvantaged communities to offer programs that are tailored to those consumers and provide them with financial freedom and access to safe and affordable products. So NAFCU is opposed to any regulatory and legislative policies that would seek to place limits on credit unions' ability to make these short-term, small-dollar loans or offer credit products that consumers want and rely on. Credit unions already offer what's called payday alternative loans or PAL loans through the NCUA's PALS program. But we have been advocating for some additional flexibilities through that program to make it possible for even more credit unions to offer that program. I mean, to be clear, credit unions don't make money off of these programs. It is something that they offer because consumers need them. I mean, there are even tighter margins on this type of program than virtually any other product. And it is offered as an alternative to other short-term loan options from sources that may not be as affordable, or consumers that they want to rely on an insured depository institution for those short-term installment loans. One of the biggest issues in short-term credit options right now is the CFPB's war on junk fees. That's something that we've been laser focused on, in particular credit card late fees, as the CFPB recently released a proposed rule that would limit the safe harbor for credit card late fees to just $8. That's a reduction from the current $30 thresholds for the initial instance and $41 for subsequent violations within the first 6 billing cycles. Now, the CFPB has argued that this is intended to help low-income communities that are disproportionately impacted by these late fees and pay the bulk of those fees. But we actually feel that it would have the opposite impact and harm those exact communities, those low income and disadvantaged communities, because it would result in a lot of community lenders like credit unions having to reevaluate their credit card programs altogether, potentially stop offering credit card products because it's just no longer economical to do so. And one of the biggest areas where our members indicated that they might to consider making some changes just because of the risk associated with the product is credit builder programs. And that would specifically and most significantly impact these exact communities. And so, we think that the CFPB, well, first of all, there are a lot of problems with that rulemaking, from a procedural perspective, but even, more broadly on a, policy perspective, they just didn't consider the impact on community lenders. And we see that a lot of times, not just with regulators, but also lawmakers, just forgetting about that community impact and what is and is not feasible for small lenders trying to reach their community, trying to do the right thing, offer products that are going to help those low income individuals, particularly in rural areas. And that's what our members are trying to do. But they are, often under fire from regulators and lawmakers alike.
Mm-hmm. Now, a sense that I'm hearing from your remarks is the phrase unintended consequences. And that's actually the title of a book that I helped research for an AEI scholar, Edward Conrad, which I recommend just as a sidebar, that any economic choice creates unintended consequences quite often, especially with these policies that, as you mentioned, they could very well dry up these programs altogether. Can you just, if you could, delve a little bit more into the PAL program? You said that you guys were seeking a little bit more flexibility. What types of flexibility, or is that something that you're working on?
Well, it's something that the NCUA is evaluating and has been evaluating for a couple of years now. I mean, they do have two iterations of the PAL program. There's PALS 1 and PALS 2, and some nuances in there in terms of, the number of, PAL loans that you can offer within, a certain number of months. And so additional flexibilities like that would make it easier for consumers to have access to even, more sources of affordable, short-term or short-term loan options that are, safe and affordable without, exorbitant rate caps, because credit unions are statutorily limited in the caps that can assess on loans, including PAL loans. And so that is, a benefit that credit unions have in this space. But there was, some concern from credit unions that the CFPB's payday lending rule would also, have a negative impact on these PAL programs and programs that are offered outside of the PAL program that have similar features, and just maybe fall into some of the criteria that the CFPB is trying to focus. And so, we advocated for an exemption for all PAL programs. Only PAL 1 loans were exempt under the payday lending rule, and future iterations, including the PALS 2 and potentially at some point PALS 3, were not exempt. Of course, that rule is now caught up in litigation, and I'm sure we'll get to that at some point during our discussion today. But there's a lot to sort through, and we are working with the NCUA to find more avenues to allow credit unions to serve their members.
Great. No, I really appreciate your perspective as one of the lenders, and then our other two panelists as the consumers. It's a really great, I think, 360 vantage point for our viewers today. Hopefully, it's helpful. So, Patrick, just I touched on your second part report of your report. So, your organization also released a second paper called "No Loan for You Too," and that reported on the unintended consequences of price controls on consumer access to credit. Just for our viewers, what were the big takeaways you wanted people to get from this report?
Well, Carrie, I hope you appreciate the reference to your book and the subtitle of our report. And I hope everybody gets the Seinfeld reference, the no soup for you, no loan for you. We love to throw pop culture references into our work to make it relevant and fun, because sometimes this stuff can be pretty thick. In No Loan for You Too, what prompted the second iteration of this report was the Pew Charitable Trust's doubling down on their narrative that when price controls take effect and interest rate caps are passed in states like in Illinois and New Mexico, that big banks and credit unions are going to step in and save the day. And we wanted to test that narrative by, again, emulating the consumer experience. And I'm very glad that you brought up the Payday Alternative Loan Program, because we had actually tested payday alternative loans as being offered by over a dozen credit unions in the New Mexico area. I'm a member personally of Pentagon Federal Credit Union. I'm a member of Navy Federal Credit Union. Both of those credit unions did not offer at the time of the report a payday alternative loan product that I was able to apply for. Rather, we had applied to over a dozen local credit unions in the state of New Mexico, where we attempted to acquire a small dollar short-term loan. And the experience was suboptimal. Del Norte Credit Union here in New Mexico, the Southwest Public Policy Institute actually banks with Del Norte Credit Union. And when I asked for the lending criteria associated with their payday alternative loan program, they refused to give me any sort of sheet that identified what the actual approval criteria was for the payday alternative loan program that they offered at Del Norte Credit Union. Similarly, we had applied at Guadalupe Credit Union, we had applied at Nusenda Credit Union, and several others, and the experience was suboptimal. In some cases, after I had submitted my application for consideration of the Payday Alternative Loan Program, I didn't get a response back from the credit union. They ignored me altogether, and I had never heard from them again. That was the case with Guadalupe Credit Union. However, there was one bright shining example that stood apart from the rest, and that was Nusenda Credit Union, where their loan process was easy to access. It was simple. I could access it through my online banking portal. The loan amount was less than $500. I think they go to a minimum of $200 for one of their loan products. The interest rate was about 17%, and I had access to those funds right away. But that was one product of over a dozen different loan applications that I had applied for. And that's hardly a shining example of the payday alternative loan program that is so often touted as an alternative to non-traditional credit options. Including in all of this, I had started my secret shopper experience with an exemplary credit score. It was over 800 points. As a result, a direct result of our work on No Loan for You 2, my personal credit score sunk by over 100 points directly as a result of my applications, specifically at the credit unions. Remember, in No Loan for You, the first report, US Bank, Bank of America, and Wells Fargo did not pull my credit. They did not conduct a hard inquiry on my credit as a condition for applying for those loans. However, all of the credit unions, or nearly all of the credit unions where they actually processed my application, subjected my credit to a hard inquiry, which resulted in a decrease of over 100 points since we had started the project. So I had decreased from over 100 to just over 700 by the time the project had concluded. These people are the traditional applicants for payday loans, alternative loans, traditional installment loans, specialized emergency loans. These people are considered unbanked or underbanked. They do not have 100 credit score points to spare when it comes to applying for these types of loans. And it took me 3 weeks to finally get approval. And the only approval that I had acquired from one of these credit unions was at Nusenda. And I've already been a member of Nusenda Credit Union for over a year. I have an auto loan there that I pay religiously. But these people don't have any other options at this point because of the interest rate cap that went into effect, effectively acting as a price control that is being advocated by well-to-do activists that know better than poor people about how poor people ought to be spending their money. I mean, that's the soft bigotry of low expectations, Carrie. And I'm pretty floored that we're advocating for the payday alternative loan program when our institute has definitively debunked that the payday alternative loans are stepping up to fill the gap. Nobody is stepping up to fill the gap. These people are being left without access to necessary credit. These people are left high and dry, and they're left high and dry by people that think they know better about how less African Americans should spend their money.
Patrick, thank you so much for sharing that experience. I think what you did with your report was so telling because, you know, so often here in the Beltway, the swamp, as they say, people talk about policies and they release white papers without actually getting, first of all, you're outside the Beltway. And then secondly, you're actually, you know, putting, you know, shoe leather reporting about what do these policies actually mean? And feel free to chime in. I don't want to put words in your mouth, but hearing what Anne said was that the Pell program needed major reform. So I think she's probably in agreement with what you're saying. It's more that we're all sort of crying out for relief here from the federal government and from state governments.
Yeah, absolutely. Patrick, thank you for explaining, you know, the contours of that report. I mean, I would argue that, you know, even though that is an incredibly interesting study, it is limited, obviously, in terms of sample size and not reflective of all PAL programs across the country. So that's, you know, one issue. But more broadly, yes, there are definitely reforms that need to take place with the PALS program. And when the NCUA was evaluating its, you know, PALS 2 option before it was finalized, you know, we to the agency that with the PALS 1 program, that only like 10% of credit unions were actually making PAL loans to begin with. So it is already a very small market that we're working with. And, you know, I had previously brought up just how challenging it is to work within the limitations of that program. And even with PALS 2, which grants, you know, some more flexibility in terms of like the minimum length of membership. That's something that's a feature within the PALS 1 program and no longer exists within PALS 2. that constrains credit unions' ability to offer loans as much as they may want to make these loans to consumers to help them. I mean, certainly they don't want credit unions turning to, a loan shark for their short-term small dollar needs, and would rather provide them a safe, affordable option quickly. But the regulatory restrictions in place do not allow them to do so. They have to run that hard credit check. They have to meet the boxes or tick the boxes off that their regulator is requiring of them, because otherwise they're going to be, in a bad position when it comes to exam time. So really, a broader reform is needed, both from the NCUA in terms of their PALS programs, but also just recognizing the need that these communities do have, and a regulatory, sandbox, if you will, right, to experiment with different types of products. That was one issue that we've been discussing with our credit union members, with other organizations, ways to craft short-term small dollar programs that maybe don't fit within the parameters of the PALS program, but are still, reasonable, well underwritten programs that don't, put the credit union at risk, and obviously likewise don't put consumers at risk, but give them, access to the funds that they need when they need it.
Thank you, Anne. And Patrick, I think your two reports, it's like traditional banks and credit unions. I mean, you illustrated in real time just how necessary a lot of these other additional alternative products are, simply because the banks and the credit unions are, in many cases, have their hands tied with a lot of regulatory red tape. So I'm going to send this conversation to some friends I've got at NCUA and flag it for them. So, but I want to bring Tirza back into the conversation. And Patrick had touched on Illinois, and I wrote a piece about this for Real Clear Policy. I think we've got the headline we can put up on screen. But in March 2021, Illinois placed an all-in interest rate cap of 36% annually for loans under $40,000 from non-bank and non-credit union lenders. Researchers with the Federal Reserve System's Board of Governors and two universities in Mississippi, they hypothesized that Illinois' move would slash the credit availability for high-risk borrowers. They were right, and the effects left these borrowers, who are often minority and low-income people, struggling. It was exactly the opposite outcome promised by those who were running the land of Lincoln. Illinois' type of installment loan rate cap, it's now being considered by federal policymakers. What do you think this would do to the marketplace if it were, expanded not only, as Patrick mentioned, in New Mexico and Illinois, nationally? What would happen to the marketplace from your perspective?
Illinois is not the first state to institute this type of rate cap, and the impact that we could expect to see if it was expanded to the federal level is the same that we've seen elsewhere. And it's that consumers have reduced options when it comes to loans and lines of credit, and they're forced to turn to other forms that are arguably less desirable, such as pawning their personal possessions. And at the federal level, we've already seen kind of versions of this pass. The Military Lending Act instituted a 36% rate cap for military borrowers. And the results of that were fairly typical and predictable of what we've seen of this type of policy. I have more polling numbers, but the Harris poll polled active military members in 2019. And what they found is that 51% of them reported being denied access to a loan or line of credit following the enactment of this legislation. And despite the fact that we know that this reduces access to credit and loans and those kinds of financial services, these types of legislation keep popping up. Back in 2021, a federal legislator introduced the Veterans and Consumers for Fair Credit Act. And what that would have done is it would have expanded the 36% interest rate to all borrowers and not just the military lenders. And because these types of bills keep popping up, I think it's really important to keep reiterating the negative impacts that policies such as rate caps have. And it's really important to just emphasize to lawmakers and regulators that when they put these types of limits on short-term loans and other necessary financial services, they're really harming the consumers that they aspire to help. And so I think that's the main takeaway for Illinois, but across the nation and at the federal level too.
Yeah, no, I think the military real world example is very telling, and it's unfortunate that they're considering broadening that to the civilian population. I mean, it's terrible enough that they're subjecting our nation's veterans who put their lives on the line to this. But thank you for highlighting that polling. So Anne, and I guess you touched on it some in the conversation with Patrick on sort of the legal ramifications, but given your strong legal background, what are some of the additional legal ramifications that your credit unions are navigating as they create lending products to serve low-income communities?
Well, I mentioned the legal challenges that the CFPB is facing currently, and from that perspective, the CFPB's payday lending rule, that would impact credit unions offering PAL loans that fit into the criteria, or payday alternative loans that aren't the PAL loans but still fit within the criteria and the rule. That is in question. The validity of that rule is being challenged before the Supreme Court. There's also a challenge to the CFPB's funding structure and the constitutionality of that structure, whether it violates the Constitution's appropriations clause. The Fifth Circuit Court of Appeals ruled last year that the payday lending rule should be invalidated because the CFPB is unconstitutionally funded. They argue that it is doubly insulated through the Federal Reserve, that the director just has, free reign to request whatever the Bureau claims it needs in terms of funding for the year from the Federal Reserve. And then that is just, essentially a blank check. The CFPB can do what they want with that money and don't have to be held accountable to Congress. So that checks and balances doesn't exist there. And NAFCU is going to be involved in that case and filing an amicus brief along with other credit union trades in support of the Community Financial Services Association of America that sued the CFPB over that rule. So in terms of legal ramifications, there could be some relief when it comes to payday lending if that rule is invalidated, because it means that, it'll be something that lenders won't have to comply with, and that the CFPB may be, limited in its options in promulgating a similar rule in the future. Now, from NAFCU's perspective, there are, of course, some bad actors in the payday lending space, but there are also, good actors, including credit unions that offer the payday loans, even though there are challenges there. To the payday alternative loans, that consumers need and want. But we've, seen the CFPB expand the scope of its supervisory authority pretty dramatically in recent years. When it comes to enforcement in particular, we think that they are taking a rulemaking by enforcement approach to a lot of their, their actions, and that is putting credit union programs and products at risk. And one big issue that we see on the deposit side is overdraft and courtesy pay programs. We've seen the CFPB conduct market research and analysis on the negative effects of overdraft programs and the exorbitant fees that some institutions charge, and the impact that it has on low income and disadvantaged communities, and essentially argue that financial institutions should eliminate all of these overdraft and courtesy pay programs and their fees, and move to other revenue streams, because the exorbitant fees just don't do more harm than good. And there have been a number of class action lawsuits filed against financial institutions regarding their overdraft policies. Specifically, the CFPB has been targeted on what's called, or been targeting what's called authorized positive settled negative transactions, and saying that those are unfair, have pursued enforcement actions against institutions that are repeat offenders in that space. And, the concern here is that there are a lot of consumers who rely on these overdraft programs. In fact, NAFQ survey results show that the majority of credit union members have opted into overdraft or courtesy pay programs. And this shows that consumers want and value this program. These programs offer critical, cost-effective short-term credit and protect consumers from turning to predatory lenders to cover their expenses. And overdraft programs also played a really big role during the pandemic as a source of short-term credit, while the nation was facing an acute financial crisis. Also, much like with many fees, the CFPB has mischaracterized overdraft fees as junk fees, and credit unions often make accommodations to waive overdraft fees, or don't assess fees when an account is overdrawn by just a de minimis amount. Credit unions really want to work with their members, or never intending to take advantage of a consumer's difficult financial situation. And in fact, our credit union members offer really robust financial literacy programs and plenty of resources to help ensure that consumers are on a strong financial footing and remain in a strong financial position. So this is particularly challenging issue because even the NCUA is taking a hard look at overdraft practices as part of their consumer protection compliance oversight through their exams. And the chairman of the NCUA has encouraged credit unions to move away from overdraft practices and find other quote unquote revenue streams. But the bottom line is that the goal of overdraft programs is not to function as a revenue stream for credit unions, it's really a lifeline for consumers. So those are some of the challenges that we're working through.
And I'm so glad that you keep picking on the CFPB. When they instituted their non-bank disclosure rule earlier this year, I was surprised when within that same 30-day period, the CFPB also created a situation where they incidentally disclosed 250,000 consumer records. And it took them months to address the problem, that the problem even existed. And then, as far as I'm aware, as of April, they still haven't notified the consumers that their financial information had been exposed. So when the CFPB is instituting and publishing circulars where they're declaring that financial institutions that are not safeguarding and protecting the data and protecting consumer privacy in the form of protecting that consumer data, when the CFPB makes that declaration and then within 6 months does the exact same thing that they've declared is illegal, I find it hard to believe that the CFPB is a fair arbiter of justice in their regulation of the financial sector at this point.
Patrick, we completely agree with you here at Independent Women's Forum, and we have said as such. And then cherry on top is that the CFPB then wants to turn around and ask for even more power and even more data from consumers, which is very troubling. But and this is just again, I think for Independent Women's Forum, we do we have an Independent Women's Network, which is a network of women all over the country, not just here in the DC Beltway swamp. Where Patrick is not residing, but we have an entire network of women all over the country, and I think we also have a chapter in Canada, in fact. And I just think it's important for us to keep the perspective of, ultimately these are people that we're talking about when we're talking about consumers. And so just to wrap up our conversation, and thank you all again so much for your time, I just want to talk a little bit about the profile of who are these individuals we're talking about, unbanked low-income Americans. Overall, it's non-Asian minorities, low-income households, less educated households, young households, and households with disabled members are more likely than others to be unbanked. This is according to the FDIC. And these are the folks who are more likely to draw on one of these short-term lending products or these other products that we've been talking about. And so just looking at the survey data and all the evidence, when we're talking about whether it's a national interest rate cap or some of these regulatory red tapes, and removing signals like credit card interest fee or overdraft fees and things like that. These are all signals that help encourage healthier financial behavior. And if you take them away, there's even more unhealthy behavior. And I came from a couple weeks ago from doing some volunteer work down in Peru, where I believe more than half of the economy is actually under the table. And it's just, I saw echoes of it when I think of the populations here in the United States. And I say this as someone who grew up in a trailer park and motorhomes. And my father, Tirza, you mentioned pawning personal information, personal things. My father used to have to pawn his watch sometimes to feed my 7 siblings and I. And to see what was happening in Peru, where almost half of the GDP is under the table, or just from a regulatory standpoint, if you're a regulator in Washington and you're wanting to get more money into the IRS Treasury, why would you then create policies that are going to shift more people into the black market and then less likely to pay you taxes? Doesn't make sense to me, but somewhere in someone's head it does. But I just want to talk about that kind of more broadly, and maybe Tirza, we can start with you, and just any kind of closing remarks as well. Do you think there's a misperception that there are these types of interest rate cap policies and other types of regulatory policies, that they're compassionate and that they're looking out for poor minority households? Do you think there's a misperception that that's as Ronald Reagan said, the most terrifying words in the English language are I'm here from the government, I'm here to help? Talk about that a little bit.
I definitely think there's misconceptions about short-term loans and rate cap policies. I've seen these kind of on 2 different platforms. So on the one hand, I think there's a lot of misconceptions about the loans themselves, in terms of how the APR is calculated and the fact that these are short-term loans. And so, like you mentioned earlier with the Thomas Sowell quote about the hotel room, no one's renting a hotel room for the year, so the annual rate doesn't really make much sense in this situation. So there's one thing, I think how the interest rate is calculated is really misunderstood. But I also think there's a misunderstanding about how much a rate cap policy can really achieve. A rate cap policy doesn't increase individuals' incomes, it doesn't reduce their bills, and it doesn't make them better able to access credit. The only thing it does is it eliminates an option for them. And even I think advocates, I'm a American Consumer Institute person, so I definitely take the consumer perspective, but acknowledging that this is a necessary financial service doesn't necessarily mean that I think it's the best thing that has ever been invented and it serves all purposes. So I think there's misunderstandings. There's a rejection of consumer agency and the ability that they can make the best choice for themselves. And then there's also a misunderstanding that protecting these types of services doesn't mean that we think they're the only services people should have, but it's just increasing the options that are available to individuals. And it's true that people who access these types of loans generally don't have a lot of other options. So protecting that is really important for them.
Great. Anne?
Yeah, so I definitely agree, with Tirza's comments, and I think NAFCU has fought hard to debunk this perception. Let's just start by saying that some of these policies are well intended, right? There are some predatory actors out there that are preying on subprime borrowers. And we definitely don't want another situation where, like we saw in the 2008 financial crisis, where we're encouraging the sort of rampant lending to borrowers who can't afford, products and are going to over leverage themselves. And that can lead to, a snowball effect throughout the economy. However, bills like this that cap fees and interest rates, many consumers, are relying on credit cards or personal loans and would be forced to turn elsewhere for short-term financing needs, including, the pawn shops, like you mentioned, or worse, loan sharks, unregulated online lenders, a black market, and, a 36% rate cap, regardless of how it is calculated, will make it, very difficult for responsible lenders like credit unions, other community financial institutions to profitably offer affordable small dollar loans, it just no longer becomes economical, like we've been talking, throughout this session. And for loan products to be sustainable, these institutions have to be able to recover their costs. I mean, that's just a basic requirement of running any business, even for nonprofit or not-for-profit lenders like credit unions. They can't be running in the red, or they're no longer going to exist. So this type of legislation would certainly reduce access to credit for millions of consumers, and especially those subprime borrowers who rely on access to these small dollar loans, credit cards, other short-term financing products. And it could actually also discourage innovation and the development of new products that are targeted for these underserved markets. So, I talked about sort of a sandbox idea to come up with new options that would offer greater flexibilities than those that currently exist with the payday alternative loans in the credit union space. That's the type of innovative thinking that could really be discouraged with these sorts of policies. So we're opposed.
Thank you. And Patrick?
Carrie, Ann, Tirza, I think there's all one thing that we can agree on here, and it's that the free market is a beautiful thing. And when the free market is left to its own devices, supply equals demand at the point of equilibrium. And when legislators that don't understand the products that they're trying to regulate, and federal regulators are recommending interest rate caps as a price control, they're setting a price floor beneath the equilibrium point, resulting in a shortage of supply and an excess of demand. And that's a problem in the free market and creates this lending crisis that we're going to be experiencing very soon. And in a position right now where the country is experiencing high inflation, lost jobs, the economy is not doing well, consumers need access to the greatest number of lending choices and credit options available to them. And the best way to do that is to let the free market do what the free market does best. By shifting the quantity of loans and credit supplied, you're actually going to be reducing the total cost to the consumer. The best way to reduce cost to consumers to introduce more supply, and the best way to introduce more supply is to get regulators to back off. So that's something that needs to happen, and these legislators and regulators need to consider in terms of helping consumers the best way is to introduce more choice in the consumer lending space to the marketplace.
Excellent. Amen to that. All right. Well, Ann Petros, Tirza Duran, Patrick Brunner, it's been a pleasure. Thank you so much for this robust discussion about lending policy. We really appreciate it. And thank you all to our audience here for tuning in. We hope that you will sign up for our newsletter. It's called The Pointer, and other news and alerts from our Center for Economic Opportunity. You can go to our website. It's iwf.org/CEO. Until next time, we hope you are well, that you strive and you thrive, and we will see you on our next policy chat. Take care.